Hello, happy Friday to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be Friday, the 28th of March 2025. Happy Friday and good morning. So before we start today's gist of Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before I went for a short break for my medical appointment yesterday, let's have a recap what has taken shape on the markets in the past two sessions in terms of their intraday performance, as well as the relevant news flow economic data release that have an impact on this movement. And let us start with the US stock market first, okay, the major US stock market indices. So the performance of the major US stock market indices in the last two sessions since Wednesday to Thursday has plummeted. So yesterday we see a continuation of that negative follow through where the SPX is down by negative 33%. The worst hit was the Nasdaq 100 down negative 0.6%. The Dow Jones Industrial Average down negative 0.37%, and the Russell 2000 down negative 0.4%. So for those who followed my daily dose on a daily basis or even a frequent basis since the start of this week, I do highlight that whatever rebound that we see in the US stock indices, the major US stock indices as per se, since the start of late last week, is more a minor dead cat bounce, i.e. counter corrective, counter mean reversion corrective rebound within their medium-term downtrend phase that is still intact in the last 3 months from the current all-time high that was printed in early part of this year. So what I could see over here is that yesterday there was actually a very interesting bearish reaction on not yesterday, on before I went for leaves, that means i.e. on Wednesday night, on Wednesday night Singapore time, that means on Wednesday US session, the Nasdaq 100, the Nasdaq 100 reacted off exactly at our pivotal resistance at 20,340, which is so the 200-day moving average, which I highlighted earlier for you guys to actually take note of. So what I could see over here is that the catalysts that drive this earlier weak technical factors has been this negative news driver where Trump himself mentioned that there will be a universal 25% tariffs being hit in all countries that has a significant car export market heading to US. That means South Korea will be them, Mexico will be one of them, and Japan will be one of them. All right, so this is the news flow that has taken shape, right, on Wednesday, where Trump's actually mentioned that this auto tariffs that's going to be imposed next week on top of that 2nd of April universal reciprocal tariffs that have yet to be decided in terms of magnitude and in terms of whether which country will be hit by that reciprocal tariffs. All right, so these 25 tariffs will be universal across the board for all automobiles export heading into US. That means automobile US imports, as per se by Bloomberg News, this Bloomberg News media over here, and it will come into effect on 3rd of April. Okay, initially targeting fully assembled vehicles. That means they didn't target the spare parts yet, automobile spare parts, but the full vehicle. Right. So for sure, you know that China BYD has also a significant share in the US, so that will be likely to be hit as well. All right, and also based on another news flow is more pertaining to the going forward, the liquidity tightening impact or the liquidity condition tightening impact in the US due to Trump's rather erratic trade tariffs policy implementation that could actually stoke inflationary pressure in the US economy. There's one Federal Reserve officials, Fed Muslim, actually mentioned that the trade of persistence tariff inflation. That means, i.e., he's going against the words of Fed Chair Powell press conference that was concluded last Wednesday also, where Fed Chair Powell sounded rather confident at that point in time that whatever inflation threat or inflation pressure coming out from this US White House trade tariffs policy is likely to be transitory or temporary. So the reason why he wants to use that word at that point in time is rather debatable. On some fronts in the chat forum, people are saying that he's trying to actually rescue the US stock market as per se at that juncture, or I mean, bigger down the line is for some. Okay, I don't know. I just leave it as per here. All right, as per se over here. But most importantly is that Fed Chair Powell colleagues did not agree with him fully on his transitory wording that is being used in the press conference last week, where it kickstart that minor corrective rebound in all the major US stock indices. So now Fed Chair Powell, colleague, based on their individual, we call it public remarks, has now starts to voice their own opinion. So previously on Tuesday, Fed Bostic actually mentioned that he only be confident to actually see one interest rate cut this year rather than two, below the median estimate that's being we call it portrayed by the latest Fed dot plot projection. And right now, another Fed official, Fed Muslim, is now warned that the threat of this we call it trade tariffs coming out from U.S. White House administration is likely to be persistent in terms of their inflationary, in terms of their negative impact on the inflationary trend in the US. That means, i.e., inflation pressure in the US may be sticky going forward. So, given this particular statements by this a slew of Federal Reserve Fed speaks, we call it Fed speak from these two Federal Reserve officials, that could potentially see a tightening liquidity condition in the US. So, a tightening liquidity condition in the US doesn't gel well for stock price performance in the US stock market. So that also reinforce this ongoing medium-term downtrend that is still intact from a technical analysis perspective, supported by this latest rather less dovish Fed speak from these two key Federal Reserve officials. All right, and also that is the particular news flow that is impacting the US stock market yesterday. And what we could see over here is that despite the fact that these automobile tariffs that Trump wants to actually ignite on 25% tariffs, has started to see weakness in the European stock market since late Wednesday. Why? Because the key automobiles, we call it European markets, or European, we call it economy, also has key automobiles company that is driving Eurozone economic growth, okay, such as BMW is one of them. So that actually causes the European benchmark stock indices to actually fall in the last 2 days. So if you look at the Eurozone benchmark stock indices yesterday, actually continues to decline. The Euro stocks 500, we consider about also including of some UK shares as well, is down negative 4.4%. The Euro stock 50, which comprises only Eurozone equities, is down negative 0.6%. And the key anchor of the Eurozone economy, which is Germany, represented by the German benchmark stock index, the German DAX, is down by negative 0.7%. Still recall that before I went for a break, I've turned neutral on the German DAX, or the German 30, as represented in our platform, due to mixed short-term intraday technical element, and the German 30 has broken down below the lower limit of that short-term neutrality zone that I highlighted before I went for my break yesterday. So later I'll share with you guys the latest technical outlook on the German 30 or the German DAX. Potentially we may now start to see a start of a multi-day in first step corrective decline. Okay, so now with that, we also start to see this trade tariffs, a much more aggressive trade tariffs approach by Trump, by having that universal 25% automobile tariffs across all nations that has significant automobiles export heading into US. That causes a safe haven goal to actually rise and broke above our short-term pivotal resistance at 3038. So gold yesterday rose and retested its current all-time high level at 3058 and surge patch above, and right now has broke fresh new record high. fresh all-time high at 3,071. So we start to see a very strong board of bullish pressure coming back into gold due to the rising risk of stagflationary pressure coming out from Trump rather aggressive trade tariff policy that has this 25% universal tariffs on automobiles heading into US. All right, and oil price continues to inch slightly higher as well, trading above that $68 per barrel for West Texas crude oil as per se. And if you look at the other Asia benchmark stock indices continues to plummet. So as we are speaking, the Nikkei 225 inch down lower today within our expectation, where we have a bearish bias before at the start of this on since Tuesday over here, where the Nikkei 225 right now is down by negative 2% because it's heavily weighted in Toyota and Honda itself, where we may start to see their revenue forecast being trimmed this year due to that 25% automobile tariffs being hit by US. And bear in mind, Honda and Toyota is also one of the key key automobile exports in US as well. Right, that means i.e. Japan. Cars has a significant we call it export market heading into the US economy. And also we start to see the Hang Seng indices continues to trade lackluster as they can't break above their 20-day moving average. All right, later I'll touch more about the Hang Seng short-term intraday technical outlook. So as for the FX market, today there's actually a report centering more pertaining to the yen or the dollar yen. So we start to see the core inflation in Tokyo or Japan capital accelerate and stays above Bank of Japan target. So what we could see over here is that the Tokyo core CPI, so that is actually excluding energy only, rose 2.4% year on year versus forecast 2.2%. All right, and the index, the Tokyo's core CPI. So in Japan, it's quite strange. They actually separate down. Core CPI only exclude energy, whereas core CPI that is much more. We call it the Bank of Japan is monitoring more, or the core rather than the core, because it strip out the fresh food volatile component as well. So the Tokyo core CPI that is excluding fresh food and energy fuel accelerate up to 2.2% year on year. So all of them actually stay above Bank of Japan 2% target. So I could see over here the trend right over here. Let me expand it. Okay, so the all items less fresh food, that's Tokyo core CPI, also continues to shape a series of higher low above the 2% CPI target as dictated by Bank of Japan. And also the all items less fresh food and energy, that's the core Tokyo CPI, is actually accelerating at a faster pace by depicting by this upward sloping purple line. So what you could see over here is that inflationary trend has started to move in line with BOJ target and outlook staying above the 2% mark. So that actually kind of reinforce BOJ gradual interest rate hike cycle. But on top of that, BOJ also got to be very cautious given the economic weakness that could be impacted on US White House trade tariffs policy implementation, especially the one on the 25% automobile tariffs that could hit the Japanese economy in terms, because do not forget Honda and Toyota is also constitute a key component stock of the Nikkei 225. So if the Nikkei 225 continues to actually show signs of weakness, it may not be leading to improvement in consumer confidence in Japan. So for a longer term perspective, I do expect the dollar yen to trade more in a very wide range configuration. But on a shorter term basis, we start to see the dollar yen now giving back its earlier short term trend upward movement that has taken shape in the last 2 weeks or so. So the dollar yen in the last 2 weeks actually rose over here. And before I went for my short break yesterday, we do have a bullish bias on the dollar yen on the intraday basis, watching out that 151 slash 1550 level, which is our medium term pivotal resistance. Then thereafter hitting that level, potentially there could be some form of bearish reaction on the dollar yen, which indeed has starts to take shape in today's Asia session. We start to see here. So the rest of the dollar major pair starts to trade sideways, whereas the dollar yen in the last 2 weeks start to push up. But right now it's intending to cover this wide gap that has been left behind in the last 5 days or so. This is a rolling 5-day performance. And interestingly, where that bearish reaction take place, the bearish reaction take place right exactly at our pivotal resistance, which I highlighted earlier, where we have that bullish bias heading up towards it at that 151, 1550 level. And right now is actually also being kind of reinforced by that rather we call it better than expected Tokyo CPI numbers that is out earlier in today's early Asia session. All right, so that potentially sum up today's daily dose of market insight. The first segment. Okay, before one thing news on highlight is Australia, more turning to the Aussie dollar. So this Australia Aussie dollar was actually kind of traded sideways. It can't goes above 63 figure level, the Aussie dollar. Why? Because Aussie dollar is still constituted as a cyclical currency, high beta currency that is very sensitive to global economic growth prospects. So with Trump trade tariffs coming in, especially the 25% automobile tariffs, that could potentially further slow down global economic growth further. So that causes the Aussie dollar for it to prevent it can't break above that 63 figure level. But at the bottom side, it can't break down below, I think 62.60, 62.40 at this juncture as we are speaking. Why? Because yesterday the current Australia government actually unveiled a rather generous tax budget that emphasize on rather steep tax cuts, and we call it some kind of consumer subsidies that allow the current government to be in a good books ahead of a 3rd May general election that the current government called for. All right, yes, 2 days ago. Yeah, in fact, not 2 days. Yeah, yesterday. So because of these generous tax cuts in the latest budget that's been announced yesterday by the current Australia government in the bid to win popular votes in the upcoming 3rd May general election in Australia, that potentially could see Australia budget deficit to be persistently in the deficit over here. So based on projection, the Australian government we call it forecast, expecting the 2025 to 26 budget deficits to be at negative 42 billion, and it will continue to stay around this level in 2026 at negative 35.7 billion, and in 2027 to 28 at negative 37.2 billion. So with this persistency in budget deficit in the Australia government due to this also this rather just unveil generous tax cuts program in a way that to win popular votes on the 3rd May election, that could actually allow RBA hands to be tight to actually kickstart a much more aggressive easing cycle. So bear in mind that after about 4 years in the last meeting, RBA finally cut their benchmark interest rate by 25 basis points for the first time in the last 4 years. But going forward, igniting an aggressive interest rate cut cycle in 2025 will be less likely in Australia. Why? Because of this persistence budget deficit that could be seen in Australia, given that latest generous tax cut budget plan that's been announced by the current government yesterday. So that actually causes the Aussie dollar a floor in the short term at around the 62 level mark. So later I'll touch more about the Aussie dollar short term intraday technical outlook. All right. So with that, that concludes the first segment of today's daily dose of market insight. Now the second segment, I'll touch on more about the longer term. I will say that it could be stretched from a horizon for multi-week to multi-month, not intraday. So there's a longer period, multi-week to multi-month situation in the US stock market. So let us take a look at the US stock market by analyzing the breadth of the US stock market rather than the price action. So the breadth is the internal strength of the US stock market as per se. So one of the breadth indicators that I look at in the US stock market will be having the number of component stocks that are trading below or and above the key respective moving average. So we know that moving average in terms of sentiment impact or sentiment effect, the significant moving average will be the 20-day, the 50-day, and the 200-day. So especially the 200-day moving average, anything that is below the 200-day moving average doesn't gel well for a medium-term trend to longer-term trend of a highly liquid tradable financial instrument. So if this this particular breadth segment, I segment it according to only 2 key major US stock indices, the Nasdaq 100 and the S&P 500. Why I use these 2 indices? Because these 2 indices are also being tracked by global fund manager, and in fact global fund manager also those guys are much more on an active basis, tends to actually benchmark their portfolio according to do this benchmark these two major US benchmark indices, the Nasdaq 100 and the S&P. Why? Because in the last 10 years, these two benchmark indices are the top performer among the four major indices in the US market. That means, i.e., outperforming the Dow Jones and outperforming the Russell. Why? Because of the AI technology team play, which is the US economy is driving in the forefront in the last decade or so. Right, so that's actually explain why I'm looking at these two index. So these are considered as the major generals. The general, we call it the, I think the 3 or 4 star general in the US stock market, if you want to look at it this way in point time. So if the general is not doing well, their foot soldiers or their colonels will also starts to turn weak as well, because leadership is weak. So what I could see over here is that the percentage component of 100, the percentage of Nasdaq 100 stocks above their 50-day moving average is still below 50 at 36.37% as of yesterday's closing price on the Nasdaq 100. And interestingly, the percentage of Nasdaq 100 stocks above the key 200-day moving average is actually inching downwards at 47 or 46%. All right, it starts to inch downwards. Very similar for the percentage of S&P stocks above their 50-day moving average, also starts to sluggish by trading a series of lower high at 40% below 50, and also the percentage of S&P 500 stocks above their 200-day moving average continues to print lower high as well and inches downwards at 45% as of yesterday's closing data on the US cash stock market. So what I could see over here is that the market breadth, as depicted by the percentage of S&P's 500 component stocks, Nasdaq 100 component stocks holding above their 50-day and 200-day moving average, continues to sluggish, print lower highs below the 50% mark. That means, i.e., market breadth is weak in the US stock market, which I would like to emphasize. Whatever rebound that we see since Fed Chair Powell temporary or transitory inflation remark on last Wednesday is more like a dead cat bounce. That means, i.e., corrective rebound or mean reversion rebound phases within their medium-term downtrend phase that is still intact. All right. And also, one thing I want to highlight from a price action perspective, we know that 2 more sessions, I mean, after today and next Monday. So next Monday will be 31st of March, which is the last month of March, and also the last day of the first quarter of this year, because by the time March ends, 3 months has passed in 2025. That means the first quarter has ended. So first quarter price action or candlestick chart is very important. Why? Because that dictates the major trend or the major movement of the any highly liquid transacted financial instrument. So like I mentioned earlier at the start of today's, not the start of this week daily dose, I keep a close lookout for the 3-month candlestick chart of the S&P 500. So you look at the 3-month S&P chart, the candlestick S&P 500 chart, now is shaping a impending bearish engulfing candlestick. That means, i.e., this candlestick now black in color, bearish, attempt to cover the small little body that was printed in the 4th quarter of last year, 2024 candlestick. All right. So if it continues to maintain this downward trajectory in today and on Monday, that means this will be a bearish candlestick formation, bearish engulfing. First time in quarterly performance, the S&P has a negative quarter since July 2023. So it has a significant impact on the sentiment of the US stock market. If this happens, that means, i.e., there could be not even multi-week, and it may stretch into a potential multi-month decline on the S&P. Okay, if higher chances of that will happening multi-month corrective decline. If by on the end of 31st of March, that means the end of the US session on next Monday, this candlestick pattern continues to hold, that means a bearish engulfing candlestick, black body covering the small little body that was depicted on the previous quarter on the S&P, that means the Q4 of 2024, that constitute a potential multi-month weakness on the S&P going forward. Very similar of what we could see on the Nasdaq 100. So the Nasdaq 100, the length of the body is much wider as compared to the S&P, because these are higher beta index, that means, i.e., more pertaining to growth. And like I say, if this momentum continues in today and holds downside momentum continues today and as well stretching into the end of next Monday US session, it will also form a bearish quarterly candlestick formation, black body constituted of 3 months of price action, because this candlestick is 3 months. One candle represents 3 months of price action. It covers the small bullish body of the previous quarter, that means Q4 of 2024. That will be a bearish engulfing candlestick on a 3-monthly chart of the Nasdaq 100, representing also potential multi-month weakness going forward. So if this candlestick continues to be bearish on today, lasting into next Monday, it will be the first time a first quarterly negative performance on the Nasdaq 100 since July 2023. So it has a significant sentiment impact on the US stock market. All right, so this is the intermarket dynamics on the share with you guys pertaining to US stock market, lasting from a multi-month to multi-week approach, a longer term approach. All right, so now let us now have a deep dive into the third segment of today's daily dose of market insight, which is the intraday technical outlook on the broad-based cross asset classes, lasting only for today in terms of their potential performance based on the technical analysis approach. So with that, let me expand my screen as usual so that you guys can have a better view of the chart. All right, so far so good. I think the screen is moving. All right, great. So let's start with the FX market first. Okay, starting with the euro dollar. Still recall euro dollar at the start of this week, we do have a bearish bias on the euro dollar, and the euro dollar has really hit our support level, which is the 200-day moving average at 1.0730, and started to bounce off it yesterday. So with that, and also what you could see, the daily time frame chart on the euro dollar also starts to form a bullish candlestick as well, right? A bullish candlestick, a kind of a turning point at the 200-day moving average at the 1.0730 support level. So with this daily bullish candle that is being formed right at a key support level at 1.0730, graphically as well as mathematically, which is the key 200-day moving average, we will now have lesser conviction to maintain the intraday bearish bias that we have previously on the euro dollar for today. So with that, we will flip to a intraday bullish bias for today on the euro dollar using 1.730 as my short-term pivotal support level. First resistance level it got to surpass will be at 1.0830, followed by 1.0860, then thereafter 1.0910 if 1.0860 is taken out today during the US session, especially given the fact that at the start of the US session, there's one key economic data to look out for. Later on the highlight what's this key economic data to look out for that could drive the prices in the FX market. So after if we manage to clear above 1.0860, the next intermediate resistance to look out for will be 1.0910. However, if price action starts to plummet down and have an hourly close below 1.0730, today intraday bullish bias will be invalidated to see the continuation of the weakness, the corrective decline that has taken shape since the start of this week, to expose the next near-term support level at 1.0680 / 1.0666. All right, so due to that positive technical observation that I highlighted earlier on the higher time frame chart, which is the daily chart, after the bounce off since at the key mathematical 200-day moving average, we will flip to an intraday bullish bias for today on the euro dollar using 1.0730 as my short-term pivotal support level. Next up will be the sterling dollar. So the sterling dollar also inched downwards and hit our support level at 1.29 figure, 1.2865 that I highlighted before I will go for a break, and that also constitute a key graphical and mathematical we call it a bullish reversal on the intraday basis, which is the rising 20-day moving average that price action managed to bounce off it, and the lower boundary of this minor ascending channel that I drew from the low of 11th of February. So with this positive observation that's being seen on the price action, as well as the hourly RSI momentum indicator, where it's managed to stage a bullish breakout above a former descending trendline resistance, that kind of institute or suggested a kind of bullish momentum that has started to creep back on the sterling dollar on an intraday basis, at least in the shorter term. So using 129 figure level as my short-term pivotal support level for today, which also correspond to the rising 20-day moving average, will flip to an intraday bullish bias for the sterling dollar. First resistance to watch out for will be 1.2980 that got rejected yesterday, and as well as the minor swing high of 20th of March. Above it sees the next resistance coming in at 130.25/130.40 next. Only a sudden push down and an hourly close below 129 figure level will invalidate today's intraday bullish bias on the sterling dollar to see a further short-term corrective decline sequence unfolding again at 1.2865, followed by 1.2810 near-term support levels to watch out for, which also correspond to 1.2810 correspond to the key mathematical 200-day moving average. So, i.e., in a nutshell, due to the current positive price action reaction of the 20-day moving average of the lower boundary of that minor ascending channel, with positive momentum reading that's being seen on the hourly RSI, we will flip to an intraday bullish bias for today on the sterling dollar using 1.29 figure level as my short-term pivotal support. Up next will be the Asia Pacific currency major dollar pair, starting with the Aussie dollar. So like I mentioned, the Aussie dollar right now, previously it can't break above 63.25, and there was actually a ceiling being created. Why? Because of the Aussie dollar is being considered as a rather high beta currency, sensitive to global growth prospect. So with that universal 25% trade tariffs on automobiles export heading into US being implemented by White House, or announced by US White House to be implemented on 3rd of April, that actually spooked global growth prospect and saw the Aussie dollar come break above that 63.25 upper limit of the neutrality level. So right now it's trading very closely to the lower limit at 62.80. So yesterday there was a bounce at around the 62.80 mark over here due to that generous tax cut budget that was being announced by the current Australian government. So with that, we still have a neutrality stance for now at 63.25, 62.80, since it's still hovering within this tight range. Only a breakdown below 62.80 will unleash a short-term intraday bearish bias on the Aussie dollar to expose the next near-term support zone at 62.60/62.40. A breakdown below 62.40 may see a revisit on the start of this month low area at 28th of February low and 4th of March swing low at 61.90. All right, so watching the lower limit of the neutrality zone on the Aussie dollar at 62.80 for today. All right, up next, lastly, will be the dollar yen. So the dollar yen, I do mention that before I go for a break, we do have that bullish bias heading into the 15130/80 medium term pivotal resistance zone. We also correspond to the 50-day moving average and the 200-day moving average, coinciding very closely to this medium term pivotal zone of 15130/80 as well. And yesterday's push up managed to see a bearish divergence that is being depicted on the hourly RSI, indicating that upside momentum has starts to wane off, where we potentially may see at least some form of intraday weakness or setback that could take shape on the dollar yen. So with that, using 15130/80 medium term pivotal resistance zone, will flip to an intraday bearish bias for at least a short term pullback that could potentially be seen on the dollar yen for today, potentially, as long as 15130/80 medium term pivotal resistance not surpassed on the upside. Next resistance, next support level to watch in the near term will be at 159.55. We also correspond to the minor ascending trend line support that I drew from the low of 11th of March. A breakdown below 1955 may expose the next near-term support level at 14890 next, which correspond to the 20-day moving average as well. However, a price breakout above 15180 will invalidate today's intraday bearish bias to see a further squeeze up towards the next resistance zone at 15220/45. Above it may see 15280 next on the dollar yen. So i.e. using 15130/80 medium term pivotal resistance zone, since it's coming very close to that level yesterday, we will flip to a intraday bearish bias for today on the dollar yen. All right, so that sum up the intraday technical outlook on the FX market. So now let us turn our attention to the major stock indices intraday technical outlook, starting with the Hong Kong 33 representing the Hang Seng Index. So with that, the Hong Kong 33 managed to stage another second day of bearish reaction off below of the 20-day moving average that is acting as a first resistance level at 23,740. So since it haven't broken down below the first support level at 23,250 level, I don't want to tighten the short-term pivotal resistance to be so tight at 23,740. So I'll still use a slightly higher level at 23,960 on the Hong Kong 33, representing the Hang Seng Index over here, 23,960 level. So as long as 23,960 level holds in terms of short-term pivotal resistance level, we will maintain the intraday bearish bias. Below 23,250 may expose the next near-term support level at 22,980, and below it may cease 22,470 next, which is the minor swing low area of 20th of February and 4th of March, coinciding or confluencing with the rising 50-day moving average as well. Unless we start to see an hourly close thereafter below 22,250, then I could tighten the short-term pivotal resistance for today to 23,740 next on the Hong Kong 33. Up next will be the Japan 225 representing the Nikkei 225. So it plummeted down low as expected below our pivotal resistance level that we highlighted earlier 2 days ago. So with that, I will tighten my short term and hit our support level at 37,030. So with that, I would tighten. So this level has really been hit. Okay, so the first resistance level right now, okay, should be this gap down over here, this potential drop right at 37,140. So as long as any bounce didn't surpass above our tighten short-term pivotal resistance level at 37,380. Why I say there could be a bounce? Because the hourly RSI now is most extreme oversold level since 28th of February. All right, so there could be a bounce taking shape. So as long as this bounce didn't surpass above tighten short-term pivotal resistance at 37,380, which will correspond to the 20-day moving average as well, we will still maintain that intraday bearish bias on the Japan 225 representing the Nikkei 225 for the next near-term support zone to come in at 37,450/220 in first step. However, an hourly close above 37,380 and a break up above it will invalidate today's intraday bearish bias to see a squeeze up to revisit 37,860. Above 37,860 may see a further corrective rebound towards the next near-term resistance zone at 38,325/38,490. We also correspond to the 50-day and the 200-day moving average. So in a nutshell, using 37,380 tighten short-term pivotal resistance on the Japan 225 to maintain that intraday bearish bias in any case of any minor bounces. Right, next up will be the German 30 representing the German DAX. So before I go for a break, I do have a neutrality stance between 23,360 and 22,790 or so. So price action break down below the lower neutrality limit and below the 20-day moving average, and as well as the lower boundary of this medium term ascending channel support that I drew from the low of 13th of January. So now I'll be using a short-term pivotal resistance level at 22,920 on the German 30. We will flip to an intraday bearish bias as long as this 22,930 is not surpassed to the upside, which will correspond to the 20-day moving average, and as well as the medium-term ascending channel now turns into pullback resistance. First resistance level to watch slightly will be 22,790 level. That is the lower limit of the neutrality zone broken down yesterday. So as long as any bounce didn't surpass above 22,920 short-term pivotal resistance level that we have on the German 30, flip to an intraday bearish bias. First near-term support level to watch 22,440. Below it exposes 22,240/22,120, which is the minor swing low of 28th of February and 21st of February this year. However, a price action push up and an hourly close above 22,920 short-term pivotal resistance will invalidate today's intraday bearish bias to see a choppy upward drift again on the German 30 first step to expose the intermediate resistance zone of 23,230/23,360. So i.e. using 22,920 short-term pivotal resistance on the German 30 where we will flip to an intraday bearish bias for today. Next up will be the major US stock indices. So the major US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average, came down as expected, hit our upper limit of the first support zone that we highlighted earlier, 42,250/42,055, which also correspond to the 20-day and the 50-day moving average. I think as a similar support zone as well. Price action on the hourly RSI doesn't shape any bullish divergence and still hovering above the oversold level. So with that, I will have a tightened short-term pivotal resistance for today on the US Wall Street 30 at 42,690, maintaining that intraday bearish bias on the US Wall Street 30. First support level to watch will be at 42,055. A breakdown below 42,055, which is the lower limit of this minor ascending range channel, will depict a much more pronounced impulsive downward sequence unfolding on the US Wall Street 30, exposing the next near-term support level at 41,700 next. All right, so that's for the US Wall Street 30, maintaining that intraday bearish bias with a tightening short-term pivotal resistance at 42,690. Next up, lastly, will be the Nasdaq 100. So the Nasdaq 100 also plummeted down as expected and hit our support level at 19,770, which was the gap up in this week Monday morning Asia session, and trade below the 20-day moving average. So using the 20-day moving average as my first resistance level at 19,970, but I will use a slightly higher pivotal resistance level at 20,120, which is also the feeble retracement of this ongoing minor slide since the bearish reaction of the 20,340 mark that we highlighted earlier on. That also correspond to the golden ratio as well of 0.618. All right, so as long as any bounce didn't surpass above the tightened short-term pivotal resistance level for today at 20,120, we will maintain that intraday bearish bias on the Nasdaq 100. A breakdown below 19,770 exposes the next near-term support level at 19,490 for today. Only an hourly close above 20,120 will negate today's intraday bearish bias to revisit the 200-day moving average and the minor swing high area of 26th of March, acting as the next intermediate resistance level at 20,340 next. So i.e., using a tightened key short-term pivotal resistance level for today on the Nasdaq 100, 20,120 to maintain our intraday bearish bias for it. Next up will be the commodities market, starting with gold XAU/USD. So as I mentioned, gold actually continues to see demand as a safe haven asset, broke above our short-term pivotal resistance level that we highlighted earlier on, 30,380. That invalidated the extension of that minor corrective decline sequence to retest the 20-day moving average at 2,978. So now we got to respect the bullish price action and flip to a intraday bullish bias over here after the breakout of the 3,058 level mark, which is now turns into a pullback support level. So that will be our first support level to watch out for today in terms of the pullback. But I don't want to use that 3,580 level, 3,058 level as my short-term pivotal support level, just in case of any whipsaw. I'll use a slightly lower at 3,038 level, 3,038 level over here. Let me put it in better writing. 3,038. Okay, let me do some adjustment. Okay, so as long as any minor pullback didn't surpass below 3,038 level that got retested it in yesterday's start of the US session, we will flip to a intraday bullish bias on gold XAU/USD. Next resistance level to watch will be 3,076/90. Above it sees 3,110 level to come in. All right, which is also the upper limit of this ongoing minor ascending channel from the low of 28th of February, and as well as a feeble extension level in this ongoing impulsive up move since the breakout of 3,038 yesterday, which is the 2.618 feeble extension as well. However, if price action starts to have a sudden downward drift and the hourly close below 3,038 level, short-term pivotal support level, that will invalidate today's intraday bullish bias to see another round of choppy downward movement to revive the minor corrective decline sequence again, exposing 3,000 level. A breakdown below 3,000 level sees the next support coming in at 2,978, which correspond to the rising 20-day moving average as well. So i.e., in a nutshell, given yesterday's breakout of that 3,038 level, we will now flip to an intraday bullish bias using 3,038 as my short-term pivotal support on gold XAU/USD. So lastly will be the West Texas crude oil. So the West Texas crude oil continues to bounce higher, you could see, and now starts to evolve within a series of higher high and higher low within this minor ascending channel that I drew from the low of 19th of March. So with that, I will have a tightened key short-term pivotal support level for today, which is correspond very closely to yesterday's US opening session, US session low as well, opening the low of yesterday's US session opening level, which is also correspond very closely to the lower limit of this minor ascending channel at 69.30. So as long as this tightened key short-term pivotal support level 69.30 didn't surpass on the downside, we will maintain the intraday bullish bias for this minor counter trend rebound scenario to play out for West Texas oil. Next resistance level to watch 70.80, followed by 71.45, which is the minor swing high area of 25th of February. Only hourly close and a breakdown below 69.30 will invalidate today's intraday bullish bias for West Texas Oil to see a choppy downward drift towards 68.77. A breakdown below it sees 68 figure next, which is the minor swing low of 21st of March, and as well as correspond to the 20-day moving average, acting as the next support level as well. So i.e., in a nutshell, still maintaining that intraday bullish bias given the fact that the hourly RSI continues to shape a higher low above the 50 level mark, indicating that it hasn't hit the overbought region yet, indicating that upside momentum in the short term still remains intact for West Texas crude oil. And with that, we'll maintain a intraday bullish bias for today on West Texas crude oil with a tightened key short-term pivotal support level at 69.30. So that also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So before the start of the US session, we do have European data to take note of will be the GfK consumer confidence data for Germany. So that's out at 3 p.m. Singapore time. That could impact the euro dollar and the German DAX price movement. That up next will be retail sales on UK at 3 p.m. Singapore time as well. That could impact the sterling dollar and the sterling pound, where market expectation is a lower print of 0.5% year on year in February, from 1% year on year in the previous month of January. And heading towards the US session will be the all important core PCE price index that will be released at 8:30 p.m. Singapore time, 1 hour before the start of the US cash stock market session. Core PCE price that month-on-month market is expecting unchanged at 0.3% from the previous month of January. As for the year-on-year, also unchanged at 2.5%. Market is expecting an unchanged of 2.5% year-on-year for February. So something to take note of as well. Okay, so pardon me, the core price index, okay, the core PCE price index on a year-on-year basis, market is expecting a slightly upward drift of 1 basis point higher at 2.7% year-on-year from 2.6% year-on-year printed in January. So if we start to see a similar higher, a much more higher print at 2.8%, that could represent that inflation in US continues to remain sticky on a core PCE year-on-year basis. So that could actually see a potential further drag in the major US stock indices, something to look out for in terms of the data announcement at 8:30 p.m. Singapore time today. Then thereafter will be a rather quiet US session, and we have two key officials speaking. Fed bar speech at 12:15 p.m. 12:15 a.m. Singapore time today, and followed by Fed Bostic again speaking at 3:30 a.m. Singapore time. So with that sum up today's daily dose of market insights. So I wish you all a great weekend ahead. And next Monday will be a public holiday in Singapore. That means 31st of March for Hari Raya. So those who are celebrating Hari Raya, I wish you all best of holidays. Selamat Hari Raya. And we shall speak again on next Tuesday, 1st of April, which is a brand new month. So with that, do have a great weekend ahead. Speak to you all again soon. Thank you.